In New York City. I'm Julie Hyman. That's Josh Lipton, and this is Yahoo Finance Live. Here's what we're watching this afternoon. Investors in wait-and-see mode ahead of a huge week for earnings in the economy. The S&P 500 is testing its record high. BlackRock's Rick Rieder will be here with the best moves to make with your money ahead of big tech earnings, the Fed decision, and the jobs report.
Plus, another deal bites the dust. Amazon dropping its bid to acquire iRobot as the $1.4 billion deal faced growing regulatory scrutiny in Europe. We've got the fallout later this hour.
Plus, SoFi, a top trending ticker on Yahoo Finance. The company reporting its first profit ever, and the stock is on track for its best day since July. We'll get analyst reaction straight ahead. Let's get you up to speed on the market action, or maybe lack thereof here, as we see stocks kind of treading water to some extent here today as they await some of the big news events we've been talking about this week. The Nasdaq right now up 0.75% or so, leading the gains ahead of a lot of big tech earnings. We're going to talk more about that in a moment. The S&P up 0.5%, and the Dow up by 108 points right now. We could potentially see another record close. It looks like we had a record intraday high being set just now. I'm just hearing from our Jared Blickery, just informing me here, and the Dow record intraday high as well is being set. That is its 7th of 2024. So again, the S&P 500 setting a new record intraday high again in today's session.
And you know what we got here, Julie? Got a little bit. I tell you, today feels like a little bit like a lull before the storm.
Yeah,
that's what I think, because we've got a big week ahead of us. First and foremost, I got earnings. I got big tech on deck. So, I mean, Apple, Amazon, Alphabet, Microsoft, and Meta, they're going to be delivering their quarterly confessionals. Our own Josh Schaefer, by the way, I want to point this out, has a very good piece today to check out, noting how strategists, Julie, expect that it really still is big tech that's going to power Q4 earnings growth. In fact, as Josh notes, if you look at those names I just mentioned, plus let's throw in Jensen Huang's NVIDIA, right? They are expected to see earnings grow a combined 54% in Q4. The other 494 companies in the SPX, the S&P 500, expect to see a decline of nearly 11%. So it still is really all about big tech.
But it's not just all about big tech, because we have a couple of other things going on this week. We have the FOMC's first meeting of the year. We have the jobs report coming on Friday. And so looking at some of the strategist reports going into this week, they're like, whoa, what do we do? Tony Dwyer, friend of the show over at Canaccord Genuity, says you can't paint things with a broad brush right now. You have to really look specifically. And he says in his note, his latest note, this week is unlikely to do much to clear up the economic or market confusion, just because there's so much coming at us. At the Fed meeting on Wednesday, everybody's going to be, and in the press conference, everybody's going to be looking for hints as to whether, in fact, the Fed is going to begin to cut rates in March. John Stolfus over at Oppenheimer says they're not likely to be pleased necessarily with what they hear. He's only looking at 2 or 3 cuts in the back half of the year. He doesn't think they're going to get started till considerably later. And then we got the jobs report on Friday, and by all accounts, it sounds like there's still a lot of optimism over the strength of the jobs report.
And that's the interesting point. Is if you're Jay Powell, you see this economic data, and obviously we talked about this. He has to like what he's seeing in terms of just the shift in inflation and the resilience of the economy. So then it is interesting. We've got some very smart people to talk to about this in a moment. But what is Jay Powell's what is his strategy in that press conference, right? In other words, he's going to be happy about the data he's seeing, but he wants to temper that. He doesn't want to cheerlead. And then, as we were discussing, kind of spark another kind of financial markets rally like we saw just last month.
Well, we've been getting a financial markets rally, right? We've got the Dow and the S&P at new records today. So does he sort of try and back off of that, try and temper some of that? I guess.
And even if he does try, does the market believe him?
That's a very good question, Josh Lipton. Let's ask somebody else
some
of these
questions,
right? Federal Reserve, of course, is set to meet this week. Investors are going to be looking out for signs that the fight against inflation is over and that interest rates will be cut sometime this year. Rick Rieder's joining us, BlackRock Chief Investment Officer of Global Fixed Income. Rick, it's great to see you. I want to start here, Rick. Has the Fed succeeded? I mean, you look at the GDP print we just got, you look at the PCE reading we just got, you look at consumer confidence, it's looking pretty good. What do you think?
So I know it's a question of the Fed succeeded or the economy succeeded. It is, that listen, I think we're seeing an economy that is much more vibrant, much more resilient than people give credit to. I mean, for a year and a half, people have been saying the recession's coming. I heard somebody say hard landings start with soft landings. I don't even understand. I mean, you look at the, there was a lot of wisdom. The claims data, the retail sales data, the GDP data, the payroll data. Economy's in good shape. It's a service-oriented economy. Service-oriented economies, we've talked on your show the last few times. They don't really go into recessions, and you're seeing some real vibrancy. And the payroll report, like you were saying at the outset, listen, you can never pick one payroll report in terms of what it does. I'm going to be focused on some things like leisure and hospitality because that's a big cyclical, and what happens with regard to that temporary hiring. So, are you starting to see an economy that's maybe slow? The cyclical component slowing a bit. That's going to be worth watching, but. Gosh, it's hard to complain about a tech-oriented U.S. economy, a service-oriented economy that can take a lot of shots. I think people underestimate how I used to call it I've called it the most resilient economy in the world. I still think that's right.
And Rick, I don't know if you heard, but I was talking to Julie there about kind of Jay Powell's mission at this press conference this week, Rick. And, on the one hand, he's got to be happy, right, with the data he's seeing in terms of the trajectory of inflation, the resilience of the economy. And at the same time, Rick, though, he doesn't want to, wave the victory sign and spark this financial markets rally like we saw last month. How do you think he kind of just walks that tightrope?
I think you hit exactly the right point. Listen, the markets, you think about what happened at the end of the year. Markets were incredibly overzealous about Fed can start cutting now. And, the markets had jumped on a couple of things. One, there was a lot of money, particularly long end of the curve that was coming in year end. And then inflation has been coming down significantly, and the markets jumped on top of that. Listen, I think that that he wants to walk a very tight rope, exactly like you said, create balance. And, will he take the tightening bias off? I think he will. But listen, I think March is aggressive. I didn't know who said it at the beginning of your show. March is aggressive because you have time. In an economy that's operating this well, there's not really a race to move rates down of any significance. And by the way, when you start going, and I think they're going to start going in May, and I think they'll do 25 basis point cuts every other meeting. But by the way, let's say the data does turn down, you can do 50s. You were hiking at 75s. So I think they've got a bit of time, and I think he's going to want to walk that back a bit, some of the overzealousness that you've seen certainly in November and December, and then so that you don't get financial conditions getting way ahead of the Fed. But I think that is going to be a key.
Well, look, Rick, things are still kind of zealous, aren't they? I mean, that's what's so interesting, right? Is that the perception was in December, the Fed's going to start in March, stocks rally. Well, perceptions have come back, right? We've seen the odds of a March cut come way down. Stocks are still up. So what would derail the rally that we have been seeing here?
I think I don't think that when you talk to people, there are very few people that I talk to that say, gosh, I really like stocks, I'm jumping in. I think there is an immense amount of cash sitting on the sidelines. And what happens is, so you think about it, the technicals drive markets more than fundamentals, certainly in the near term. Think about what's happening. There is going to be almost $1 trillion of equity buybacks this year. There's no IPO calendar. All buybacks, no sellers. There's a huge amount of money sitting in cash. If all people do is take some of their salary, 401k money, and I'll put a little bit of money in equities, there's not a lot of sellers. And so what happens is the market just continues to take some of the cash and move it in, and you don't have anything that gets in the way of it. So I don't really think there's like a collective, let's buy stocks. I think it's, gosh, I got money coming in, I've got to asset allocate. The big thing I think this year that's different than last year is now a good deal of that money's coming into fixed income and income producing assets that are saying, gosh, I've been sitting in cash, I'm getting 5 and change in a money market. Now maybe I'll move into income producing assets. Maybe I don't get those huge returns in equities and I can augment it with income. And that's a big divergence from what we saw last year, where people were like, get me out of the way of higher interest rates, I'll sit in cash.
And I'm interested, Rick, when you look at the credit sectors right now, which ones kind of make sense to you, Rick? Is it investment grade and high yield? And also, where don't you see value?
So first of all, the rates I don't see spreads. So if you take normal spreads, you think about versus history, they're not that interesting. And in fact, high yield, they're not that interesting at all. What I do think is really interesting, though, is owning assets in yield. So if you think about why are companies borrowing at these levels, they're only borrowing at, why is high yield borrowing at 8-ish? Why is investment grade? Can you buy investment grade at high 5s to 6? It's because the risk-free rate is so high. These companies term their debt out. They're in better credit quality than they've ever been. Where what I really like is just own these assets in yield. And don't focus as much on spread, because we're going to get tons of issuance out of the Treasury. But a lot of these companies today are pretty darn attractive. Where I really like is Europe, because a dollar investor, you can swap back to dollars. And listen, an environment where we can get these sort of yields, EM is just okay. Do I want to own a lot of EM? If I could build a portfolio of 6.5% yield, we just launched this ETF, or didn't just, about a year ago, that, we can get 6.5 using things like agency mortgages, investment grade credit, high quality assets, and build really nice yield into a portfolio. So it's spreads that aren't that interesting. Places like we have a lot of volatility, not that interesting. And, just build yield and sit on it. Let the yield work for you this year.
Where do you think the 10-year yield is going to end 2024, Rick?
So, what the 10-year to me is like? It's like a lost soul that found its home. And so if you take where we've been bobbing, where it's this incredible move. You think about when we hit 5%, people say we're going, the 10 years going to 6. The 10-year moves, and historically has been where nominal GDP is. Nominal GDP, if you say real GDP this year is 1.5 to 2, inflation is 2.5. Let's say we end about 2.5-ish. The 10 years at 4%. The nominal GDP is 4%. 10 years at 4%, a little behind 4. I think the 10. I think the key for rates is volatility is coming down, which is good for equities. Where does it end the year? My sense is with a Fed that's cutting rates, I think you'll get the 10-year 3.5 to 4. But I think the big story this year is finally, after 3 years of not being able to sleep at night because rate volatility was all over the place, mortgages, so it's hard to buy agency mortgages because rate volatility is so high. I think the story this year is the 10-year found its place, and now we can own a lot of income and just hold the income.
Well, that's good news for you, I guess, in your sleep too, Rick. Thanks so much for being here. It's always good catching up with you. Really appreciate your perspective.
Thank you.
Thanks. We're just getting started here on Yahoo Finance Live. Coming up, Amazon announcing it will not move forward with its acquisition of vacuum maker iRobot. We're breaking down the M&A market more broadly on the other side. And Boeing is set to report earnings this week, but as federal inquiries into the 737 MAX 9 jets continue, could the plane maker be in for some major changes at the top? Also, how do investors navigate the mathematical complexities of trading options? Well, today we're kicking off a week-long series, Options 101. We'll debunk the myths, decode the secrets, and help all investors harness the power of options. Stay tuned, all that and more coming up when Yahoo Finance comes back.
Let's check in on some of the top trending tickers as we count down to the closing bell here. China's largest property developer, Evergrande, facing liquidation after courts deemed the company incapable of delivering on restructuring plans. Shares of U.S.-listed Chinese companies being dragged down as well in today's trade. So that was the headline on Evergrande here. So ordered, Julie, to liquidate by this Hong Kong court. Of course, at one time, China's biggest property developer by sales, and kind of brings up this really broader question we've asked different strategists about, which is, do you want to put money to work in China? Now, is there opportunity there, or at this point, do you see sort of a giant value trap?
Well, and this story is particularly interesting for foreign investors in China, because how the court handles this liquidation is relevant to foreign holders of some of those assets. And so foreign investors are going to be watching this very quickly as well. But what strikes me as we looked at those other China stocks is it's been a pretty uneven reaction. You know, yes, some of those stocks have been down sharply, but then like an Alibaba, which is an enormous Chinese company, it's not down that much. PDD, Pinduoduo, is down quite a bit here, and we were trying to sort of figure out what was going on. There's one analyst over at Citi who says maybe it is some of the chatter around potential import tariffs on Chinese companies. Pinduoduo owns Temu, which has been increasing its business in the United States. It's an e-tailer. So maybe that's part of what's going on. If there is another Trump presidency, we could see that kind of a tariff put in place. That's something he's talked about at least.
Yeah, I mean, we've had market strategists use very strong language about whether you want to put money there, right? I mean, they've used words like uninvestable. Now, we did hear there is another side that we heard from Dan Niles last week, which I thought was really interesting, as Dan is well-known, well-respected tech investor. He took the other side of that trade and basically said, listen, if you think China's economy is going to zero, it's uninvestable.
Right.
But when he looks at some of these names that we're talking about here, like Baidu or Tencent, Alibaba, he sees revenues climbing but stocks falling. So he said that, the question for him isn't whether it's uninvestable. The question for him is basically, you just have to ask yourself, an investor, do you think you're being paid to take risks to move those things?
And the other question you have to ask is, how much volatility do you have the stomach for in the meantime while you're waiting to get paid potentially? So that's definitely part of the factor as well. Let's talk about shares of Lucid as well. Those shares spiking higher after Motley Fool issued a buy alert on the EV maker, saying that Lucid's valuation could see a substantial rebound and the shares a significant gain above current levels. Listen, we got to couch this. Stuff doesn't always move on Motley Fool calls, right? And the call did say that this is an exceedingly slim bet that the stock could skyrocket here and go to even 70% of Tesla's value. So it was not a full-throated buy recommendation here. But the reaction in the stock has been kind of incredible.
Yeah, I mean, even with today's pop, it's still down about 25% this year, about 70% over the past 12 months. I mean, what interests me about Lucid, and it's also, you can throw in Rivian, you can throw in Tesla. Like, I think everybody's still trying to decide what this EV market broadly looks like this year. What does demand actually look like? And if you just read Tesla's print and listened to Tesla's call, I don't think investors took a lot of comfort about what that market actually looks like.
Well, the other big thing to consider here is whenever I see a pop like this, you know where I go. I go to look up short interest. And according to Bloomberg data, 29% of the float of Lucid shares is shorted. That is an extraordinarily high number.
Yeah.
So what happens in that case is you see a little bit of buying, and then people who have short the stock close out the shorts. That then exacerbates the buying, pushes it up even more, which is probably at least part of what's going on here today.
And finally, let's get to the last one here. Another day, another deal down the drain. Shares of iRobot, they're down big today as Amazon announces it will not move forward with its acquisition of the vacuum makers. They see no path for regulatory approval. So if Amazon, Julie, officially drops the planned acquisition of iRobot, the Roomba maker, of course, we knew regulators, and we talked about this, the EU weren't happy with this deal. And then it sounds like the vacuum maker is quickly taking these steps, CEO stepping down, cutting jobs. Looks like about 350 jobs, about 30% of the workforce. For Amazon, listen, they have the resources to keep building out this kind of footprint in smart home devices, but it does speak to kind of broader issues of the regulatory backdrop we've seen here.
Yeah, I mean, this is another one that was going on for a while. They first proposed this deal back in August of 2022, and it's taken until now for them to finally say, forget about it, we're done. They are going to be paying a termination fee to iRobot of $94 million. But to your point, iRobot on its own has been struggling here. And actually, Amazon had cut the purchase price last year for iRobot before now taking the step of abandoning the deal entirely. So maybe on some level, Amazon feels like the regulators have done it a favor since it was going to take on what had become sort of a struggling asset. But to your point, it does speak to the broader regulatory environment here. It looked like in the EU, maybe they would have accepted some concessions from Amazon, but Amazon got to a point where they didn't want to kind of do the back and forth anymore, it seems. Yeah.
We have just the man to talk more about this.
Yes, we do.
I don't know if you knew that.
Yes,
this year in deal making is already off to a wild start, especially as deals fall apart. On top of the Amazon iRobot deal, JetBlue Spirit merger also facing, we know, regulatory headwinds after a judge blocked it. But we've also seen a string of deal activity to start the year. Some of the largest deals so far: Synopsys acquiring Ansys, Sunoco announcing its deal to acquire Newstar, and Chesapeake merging with Southwestern Energy. Joining us now is Barron's reporter Jacob Sonnenschein. Jacob, it is good to see you. Maybe, Jacob, just kind of, we'll start here with kind of setting the scene for us in 2024. You know, when it comes to M&A, Jacob, these, different moving pieces, financing costs, the election, got geopolitical conflict, giving all that, Jacob, I'm just getting interested to get your take. Where are we and how do you see kind of the market evolving over 2024?
From a macro standpoint, just when you mentioned the election and all that stuff, but from an economic standpoint, this year, whether earnings in the U.S. disappoint or surprise to the upside, earnings on the S&P 500 are going to grow. We're getting an economy that's growing low to mid single digits at this point. Sales are going to grow in line with that. Margins are going to be fine, and bottom line growth could be close to the double digits, somewhere around there. As long as the market is confident in that the economy is holding in there, and that the Fed is lowering rates, you have a cost of borrowing. If you're a buyer of a company, you have a cost of borrowing that's moving lower, and your return on a purchase with earnings looking pretty good is brightening. So you can finance that deal. You have a good stream of profits coming. You compare that to last year, you should get growth in M&A this year after it was down last year to about $3 trillion globally.
All of that may be true, but if the Feds come in and block your deal, you're out of luck, right? So, Jacob, what kind of environment are we seeing that regulatory environment as a curb on even some of these proposals being made in the first place?
Yeah, so I think in the airline space, it's going to be a little bit tougher from a regulatory standpoint. First of all, like you guys mentioned with Amazon and iRobot, the EU is known to be a little bit tougher from a regulatory standpoint in the U.S. With airlines in the U.S., you had JetBlue, trying to make a play for, another small discount airline. They would have to buy that for $3 billion. JetBlue doesn't even have $1 billion in cash. Would have to use a lot of debt. It'd be a very difficult deal to do. And then you had, from a regulatory standpoint, the argument was, well, consumers need to have the discount segment of the market there and available for them. You have to make sure that market is competitive. You can't have too much consolidation in that discount part of the market. So it's tough for airlines. When it comes to pharma, it's a little bit easier. There have been some regulatory arguments made against Amgen's $28 billion purchase of Horizon, but that deal is going through. You're seeing more deals in pharma going through because you're talking about large drug makers that need to boost their pipelines, that can pretty easily make acquisitions. And the argument in pharma and drugs is harder to make from a regulatory standpoint than airlines, where consumers need to have that discount part of the market.
And Jacob, another issue I want to get your take on, it can just take so long, Jacob, to get these deals done now. I mean, really, think about like Microsoft Activision or Broadcom VMware. I'm just wondering, Jacob, whether you think that is a kind of hurdle. Do you think a lot of CEOs think, what, I see an asset, I think it makes sense financially, I think it makes sense strategically, but wow, I know it's going to take forever to cross the finish line here. Do you think that is a challenge to the market in 2024?
I wouldn't say I don't think it's a challenge. I think again, it's very sector specific. Like obviously the Microsoft Activision situation, has been a pretty drawn out situation. If you're a company that thinks that you can that your earnings and the business is performing well today for the next year, then you can hold your cash and say, we'll see if we can make this large acquisition. maybe there are some companies that say, you know what, let's make sure we get those dividends, those buybacks flowing. Probably something like Microsoft is going to want to make its strategic acquisitions. But I will say, by the way, in pharma, I think there's more to happen in pharma. We've already gotten tens of billion dollars of deals in pharma in the last year or so. But I just added up net debt for three big pharma companies. That's not even all of them. It's like $80 billion, and EBITDA earnings next for this year is going to be almost $70 billion. That's really feasible. There's so much cash out there today in pharma for more deals to happen. In terms of deals taking a long time, I think if a company really wants to get it done, they'll get it done.
Yeah, maybe Amazon and iRobot didn't necessarily want to get it done as much. We'll see. Jacob, thank you so much. Appreciate it.
Thank you.
Coming up, we're kicking off a week-long series, Options 101. We'll help investors navigate the mathematical complexities of trading options and make the best moves for their portfolios. Stay tuned. We've got more Yahoo Finance after this.
A new generation of retail traders is flocking to options trading as an alternative to plain vanilla stock investing. But the options arena can be complex to maneuver, and there are also pitfalls to avoid. So we're starting off with the basics in Yahoo Finance's Options Week 101. And this is sponsored by Tasty Trade. And now joining us to break this all down is Interactive Brokers Chief Strategist, Steve Sosnick. Steve, thank you for joining us here today. And let's start with a very simple definition here. This is a stock option definition, financial contract that grants the buyer the right, but not the obligation, to buy or sell a stock at a predetermined price within a specified period of time. Just tell some of the important aspects of this for us.
Well, it's important to remember, Jared, that it is a right, and that's where the word option comes from, as opposed to, let's say, a futures contract or actually buying the stock where you're obligated to own that underlying security. As a result, the price tends to be lower, but the very important parts are you have to get that target price correct because there's a predetermined price, and you have to get the time frame correct. So there's a lot of it's much less of an outlay, but you really have to get everything just right for it to work out for you.
All right, with that, we have calls and we have puts. Calls are the right to buy a stock, put is the right to sell, but that's if you're long. If you're selling the stock, it's a little bit different matter. And for the newer investors, we're probably going to be thinking about buying calls or puts there, right?
Yeah, most people start off by buying options outright. There are a lot of people who do end up writing options, particularly covered calls. I know you'll get to that later.
We're going to get to that tomorrow, actually.
No, I'm not gonna front run the next guest. But so what happens is, it's typical to think in terms of buying them to begin with. And again, it's a fairly limited outlay compared to the price of the stock usually to either speculate about whether it's going to go up over that period of time or whether it's going to go down depending on the contract.
Defined risk, a concept we're going to come back to. So the structure of a call option here, first of all, one option equals 100 shares, and then we have a couple different things. Maybe you can go through and outline the importance of each one of these things.
Yeah, so when you see the price of an option, you have to multiply that by 100. So if you see it trading at $1.50, your outlay is actually going to be $150 because it conveys the right to buy 100 shares. One contract buys 100 shares. The expiration date is predefined. So you're buying the March 190 calls on Apple.
Yeah,
so
there's
you have
weekly and monthly expirations there.
Even dailies for certain ETFs and index options. But we'll stick here to the weeklies and the monthlies for common stocks. But you do specify your date when you buy it, and you specify your strike.
Right there.
So the expiration date and the strike, and when you go to look at the quote, that gives you the premium.
And that's what you're paying if you're buying it.
Exactly. So you pay that premium. And especially if it's an out of the money option, meaning that if it's a call, the price is above the strike. The strike price is above the current price, or a put, the strike is below. That is pure premium. There is no intrinsic value to that option. It's just really what you're paying for the right to speculate on the stock price over that period of time.
So important to say that premium can just disappear 100%. That's something that you're just outlaying from the beginning there.
Premium does, there's few guarantees in options land. One of them will be that there is no premium left on expiration date.
Yes.
It's either going to be in the money or it's going to be out of the money. And this chart shows you that. So
we have first of all, this is for an Apple 190 call. And this is a typical profit and loss chart. So get used to this. We're going to be showing a lot of these. And in this example, this is the 190 strike and it's $3.50 per share. But maybe you can try to break down the structure of this.
So if you're paying $3.50, so this little red line means that if it closes below 190, you lose all $3.50. You have to get it up and above 190, $3.50 for you to even break even. On the other hand, though, the advantage, the appeal of options is you could see how fast that line accelerates.
Right.
So if you get above that 190, $3.50 hurdle, the strike price plus the premium paid, that can accelerate very quickly, and that's the appeal that keeps people trading in options.
And another thing is, I look here, the red line, it never goes any lower. No matter how much the strike or how much Apple share price decreases, you're only going to lose that fixed amount.
That's true. It's very defined risk. The important thing, though, to keep in mind is most options expire worthless.
Yes.
So it is important to realize that
you're kind of giving that up in a lot of instances.
You are giving that up, and on average, it is speculation. And I think, unfortunately, some people treat it almost as gambling, and gamblers don't win most of the time. So you do want to use your defined risk, but you need to use it intelligently.
Yeah, good point there. The house tends to win, and that involves writing, but we're going to cover that later in the week. Yes. For now, let's go through some of the benefits here, because we have leverage, hedging. We talked about defined risk, so maybe you could talk about leverage and hedging a little bit.
Well, sure. Well, the leverage part was in that graph before, because we mentioned that it needed to get past 193.50.
Right.
If you got to 197, well, that option is worth $7, and then you've doubled your money. So there's your leverage. So it's hit or miss to a certain extent, and when you hit, you can hit big. And that, I think, again, tends to be a little too appealing sometimes to people.
Yeah, we saw that in 2021.
Exactly. Hedging, on the other hand, tends to be, if you're long a stock and you want to protect yourself on the downside, you may want to purchase a put. There are other ways to generate income, which again you'll get to with writing calls. That's hedging. And so the whole point of options was really not as a tool for speculation, but as a tool for risk management, to transfer risk and to allow hedging between different parties who wanted to, some wanted to assume risk, some wanted to lay off risk.
Very good. We got less than a minute, so we got to go over a couple of the risks here. Leverage can work for you, can work against you. Also, options are complex, and then time decay. We didn't talk much about that. Maybe you could just address time decay with a little bit of time.
Time decay is...
We're experiencing it now.
Time decay is one of the most unrelenting features of option trading. Well, as I mentioned, I can only guarantee you that there will be no premium on expiration, and that does dissipate as the time goes by. The longer you have for the trade to work out, the higher the premium of the option. As you get closer and closer, that premium declines. The risk, by the way, with trading very short-term options is that premium really decays very quickly. It's not linear. It's an exponential function. Sorry for getting too mathy,
That's all right.
but you fall off a cliff as you get close to expiration.
We really thank you for appearing on day one of Options 101 week here. Steve Sosnick, thank you. Josh, Julie, back to you.
All right, Jared, thank you so much. Appreciate that. Meanwhile, searches for Taylor Swift on Twitter have been blocked following the social media site being flooded with AI-generated explicit images of the singer over the weekend. The deepfakes sparked outrage with fans and lawmakers and have since been traced back to being generated on Microsoft's text-to-image generator. Here with more is Dan Howley. Dan.
That's right. This kind of generated image kind of splash across the internet, most prominently showing up on X, but on other platforms as well, is really kind of stirring the pot as far as how regulators want to respond to this kind of content online. Obviously, these kind of deepfake images are generated using AI. 404 Media reported that they came from one of Microsoft's products, but Microsoft says they haven't been able to recreate this on their own, but nevertheless have improved their guardrails for their platforms. And I tried to go on Microsoft Designer, typed in Taylor Swift, and it wouldn't even let me do that. But you can still see these images on X. They have blocked searches for Taylor Swift, but as well as Taylor AI. But if you search for something like Swift AI, it's still going to come up. That's because Swift is a coding language. They're also going to continue to circulate regardless of what X does at this point, because as we all know, once it's on the internet, it's basically impossible to get rid of. So now regulators have to come up with a plan, if they can, as to how to kind of put some kind of law into place around this. The EU is working on laws about that, but the US is notoriously slow when it comes to putting out any kind of AI law through Congress. And it's important to point out that this kind of content obviously is done without the victim's consent at all. But it's not the first time something like this has happened. We've seen generative AI used for nefarious purposes before, whether that's the deepfake voicemail for President Biden during the New Hampshire vote. And we'd also seen a AI-generated explosion outside of the Pentagon that hurt markets for a time being in 2023. So this kind of problem is going to continue to grow until regulators come up with a way of dealing with it.
Well, Dan, to your point, we have seen this in recent years. I'm curious if this Taylor Swift situation is different in any way. Is it just because she's Taylor Swift and she's so popular? Is it because there is technologically something different going on in this particular case? All of the above?
Yeah, I mean, it's all the above. Obviously, Taylor Swift's popularity, especially at this moment, has a lot to do with it. I mean, this kind of happened, obviously not the same situation, but her kind of standing led to those hearings about ticket prices and then ticket scalping and things along those lines. But this has unfortunately been around for some time. People have been photoshopping heads of celebrities onto other people for forever, right? It's just the fact that it's so easy to do now with this technology means that the spread of it is going to be far faster and the volume of it will be far more. So I think that's why we're seeing this kind of reaction. It's, it's Taylor Swift, and people are going to have a response because of that, and B, just because of the simplicity of the technology that allows people to do this and then quickly spread it across social media. So I think those are the real reasons why it's generating so much buzz and why X had to take action.
Do we know, speaking of taking action, Dan, my understanding was these images, and correct me if I'm wrong, they were created using a Microsoft tool. Did Microsoft respond to this?
Yeah, they said that they weren't able to reproduce this on their own, and that they're, regardless, putting their better guardrails into place to ensure this doesn't happen. And this has been something that, companies have been talking about, these kind of guardrails to prevent the misuse of this technology for some time. The kind of technologist side of things will say, look, it's a technology. It can be used for good and bad. It depends on the person that's using it, which is, a fair thing to say. But, when you're a victim of something like this, you probably have, rightfully so, a much different kind of take on it. So it's going to be interesting to see how these two kind of opposing directions kind of come together, if they can, and if Congress can actually do something. So far, we haven't seen anything from them of significance. The Biden administration has released its AI executive order looking at ways to kind of safeguard against certain types of AI misuse, whether that's discriminatory uses, things along those lines. But when it comes to this issue of deepfakes and how they're used, and if they can be controlled, that's kind of still out there. And while Microsoft says they haven't been able to recreate this, it's important to point out that there's other AI models out there that people could use, could train, and could put out deepfakes with, regardless of whether a large company is doing this or not. So it's something that's going to be here with us now going forward. It's not, there's really no putting the genie back in the bottle here. It's just going to be a permanent problem from here on out.
All right, we'll keep watching. Dan, thank you so much for your time. Appreciate that. Meanwhile, shares of SoFi, they are soaring after a record quarter. We're diving into the fintech's earnings next.
Shares of SoFi are surging almost 20% after reporting the company's first ever profit in the fourth quarter. Revenue also beating Wall Street's expectations, soaring by more than a third during the period. Joining us now to discuss the quarter, Dominic Gabriel, Oppenheimer Executive Director and Senior Analyst of Equity Research. Thanks for being here. So what's going on here at SoFi? It looks like it has sort of changed its business mix, kind of leaning more on financial services, less on strictly loans. Is that what's kind of unlocked this profitability for them?
Well, thank you so much for having me. I think people are surprised that they have the earnings power and the diversity of revenue that they really do. And we've been saying this for quite some time that, it's the diversity of the revenue streams that they've built out that are creating this, ability to kind of supercharge some of these segments. I mean, the financial institution, the financial technology segment, obviously both of those are just expected to have over 50% growth in 2024. Clearly, there's a lot going right at SoFi right now, even when they decide themselves to pull back on some of the loan originations.
And Dominic, how confident are you here that we're going to keep seeing this ramping profitability in the quarters ahead? And if so, how come?
Sure. So we've had in our model for quite some time, and it's a great question, and it's a critical one because we've had in our model for quite some time that they were going to continue to have, adjusted EBITDA margins improving over time. The fact that this quarter had a 30% margin is really kind of the long-term goal that they've already achieved in this quarter. The guidance is obviously for continued 30% roughly margins here. And, it's really important that companies that came out in SPACs and the like hold to their focus and their targets that they've laid out at the beginning or have even updated, but really deliver on some of these targets. And SoFi is one of them that I believe continues to deliver on their expectations.
So, Dominic, I noticed you have, if I'm not mistaken, a market perform on the stock. What are you waiting to see from SoFi that would tell you, okay, it's time to get in here?
Yeah, I think, we have consistently talked about an amazing buying opportunity when SoFi approaches $7. We've talked about becoming less bullish when it hits about 10. We've played that range multiple times. It's allowed us to do that. The thing that matters is this profitability improvement enough to kind of break this trading range? And we think the fundamentals are obviously improving. Is the overall climate enough where they can break through? And, I have to admit, this report is based on GDP contraction in 2024, which means it's probably at the low end of where they'll deliver. And it probably would leave room for upside.
And Dominic, I'm also interested to get your take on, how you judge valuation for this name. And, big pop today, obviously. It's now up about 40%, Dominic, over the past 12 months. How does valuation look to you for SoFi?
Yeah, it's another really important point for SoFi in particular because we use a sum of the parts analysis, and I think it's pretty critical for this stock. And I actually hate sum of the parts because it doesn't usually work. But for SoFi, it feels like it's the right call because they do have this pretty significant technology business. Otherwise, the rest of it is really a specialty finance company. But especially when you're growing this technology business, 25%, 20%, it can really determine, even though it's not a lot of revenue, it can really swing that multiple around. And we've said this for a long time since we started covering the stock. And so I really think a sum of the parts analysis is the right way to go versus just tangible book value. That would miss all the earnings that this technology business provides. And so that's why we think it's important to use a sum of the parts. And it comes to that range of roughly $7 to $10.
And Dominic, I want to get you out of here on this. Obviously, you know the company backwards and forwards. You know the C-suite really well. Anthony Noto. So I want to get your take on Noto. He's former Goldman banker, executive at X. He was named CEO of this company almost exactly 6 years ago. Dominic, what grades do you give Noto?
Look, I have talked to him quite a few times. We've hosted him for different events. I think he's a really clear deliverer. And all that I care about, honestly, is his execution. And he continues to do that. And I think they have a lot of scrutiny sometimes because of the way they do some of the accounting and whatnot, because people aren't used to fair value accounting. But I think that he should get high marks on his ability to execute the dream of this company. And you're seeing it in some of these numbers time and time again, and in different market environments, right? I mean, that's what he's doing. He's creating a overall well-rounded financial institution, and I think you should get high marks for that.
Dominic, it was great having you on the show today. Thanks so much for your time and your insight. We appreciate it.
Thank you so much for having me.
Moving on, Walmart offering new perks for U.S. store managers. The move coming after the retailer announced it's raising the starting base pay and redesigning its bonus plan. Here with the details is Yahoo Finance's Brooke DePalma. Brooke.
Good afternoon. Well, untypical way to share this announcement. U.S. CEO John Furner actually taking to LinkedIn to share this announcement this morning. The latest effort to attract and retain U.S. store managers is a $20,000 Walmart stock grant for U.S. store managers. That's starting in April. Now, it is based on the store format. For example, managers with smaller store formats are eligible for less. So for supercenter Walmarts, that will be $20,000. But for a typical Walmart, that stock grant will be $10,000. And as you noted earlier, this is the latest incentive for U.S. store managers. Earlier this month, they moved the U.S. store manager salary from $117,000 per year to $128,000 per year. And they also redesigned that store manager bonus program. Now, U.S. store managers are eligible for a bonus of up to 200% of their base salary if that manager hits all the targets. And so if you take this all in consideration and you say that this is the most successful Walmart U.S. store manager, well, then the salary is upwards of $400,000 a year. Now, with these three incentives in mind, really U.S. CEO John Furner saying that the job of a U.S. store manager for Walmart is far different than what it used to be as e-commerce continues to boom. More consumers flock to their stores for grocery. And really, earlier this year, or rather late last year, they did also announce that $9 billion plan to modernize in stores. And so ultimately they're saying here it's a different Walmart store than what it used to be. And they want to offer their store managers more. A far different story than what we're hearing from the rest of the retail industry. Macy's recently announcing layoffs, as well as Wayfair.
True, but at the same time, when it's something as big as Walmart, it tells you something not just about Walmart, but maybe about the bigger job market and the demand for workers right now. Brooke, thank you so much. Appreciate it. Well, counting down to the closing bell, let's get a quick check of the markets. The Dow and the S&P heading for record closes, both of them touching intraday records. The Nasdaq 100 has been on that track as well. The Nasdaq Composite is leading gains today, up by 1% as we await some of the big earnings reports later in the week. And there's also some news on the Treasury side of the equation here today. So we're watching bond markets closely and how they sort of feed through to what's going on to stocks. The Treasury just out and has reduced its estimate for how much it's going to borrow this quarter. That was a surprise to some economists because of the widening fiscal deficit. So the Treasury Department is now saying for January through March, it is going to borrow $760 billion. The prior forecast from Treasury was $816 billion. So seeing a bit of a movement downward in yields here as we get that news. The 10-year yield now at 4.09%. Coming up next, we got the closing bell, and we'll tell you about some more trending tickers. Stay tuned. closing bell on Wall Street. So let's do a check of the markets here because looks like we got a record close for the Dow and the S&P here because the gains that we are seeing today, guessing the Nasdaq 100 is there as well. So we saw the Dow climbing by 223 points. You know, it's funny, Josh, because earlier in the day we were saying that this felt like sort of a calm before the storm. It's a pretty good little rally for the calm before the storm, with the Dow here up 0.6%, the S&P gaining 0.75%, and the Nasdaq up more than 1.1% here. And again, seeing these gains here, pushing things to new records. So, you know, it looks like investors are feeling pretty good, perhaps, about the tech earnings, about the Fed, about the jobs report that we're going to get this week.
A lot on deck.
Yeah.
Here's some other. You want to get some trending tickers? Should we do that as well? Okay. Bank of America, sure, why not? Bank of America lifting its price target on Chipotle, the move coming amid higher than expected sales volumes generated by the restaurant company. So this one, Julie, was interesting. This was sort of a broader, B of A restaurant earnings preview, and kind of analysts in broad strokes kind of laying out what they expect to see, telling their clients their checks indicate restaurant demand generally improving through Q4. Inflation, they note, for most commodities in line or lower than last quarter. As input prices fall, they point out promotional intensity increases, but they don't think that necessarily is going to mean margin pressure. So kind of pretty constructive. And as for Chipotle specifically, they lifted a number of targets. Chipotle, it looks like they go to 2,700.
Yeah, Sarah Senator over there leading this coverage and this preview of what we're going to hear from the restaurants. I'm a fan of her work here, and she's looking at higher than expected sales volumes that we saw for Chipotle in the past year, and also looking at average unit volumes to go higher as well. So a lot of optimism here, looking at about $8 billion in EBITDA from Chipotle. So that's how they get at that price target for the company. Right. Yeah. All right, let's also talk about 3M here. Now, this stock is not moving that much, but a lot of folks closely watching the news coming out here. A $6 billion settlement over allegations of its earplugs causing hearing loss. The company is saying the claimant participation is on pace to exceed the 98% threshold required by the agreement. In other words, it looks like they're getting to the point here where then they can put this behind them, which is something that's been a bit of an overhang for the company.
Yeah, I mean, this was a big source of uncertainty if you had money yet you put to work in 3M. And it sounds like mentioned the kind of what they're hitting there in terms of participation, right? The stock so far this year, Julie, we're already down about 10%. Right. And we had this headline today, but remember earlier this month, Q4 earnings beat, but guidance missed, so it's been kind of rough sledding there.
Yeah, and we're talking about a lot of people, by the way, who are involved in this settlement, more than 250,000 eligible claimants here who have now signed on to support this. So we'll see if, it doesn't look like it's causing much relief in the stock today, but again, something that maybe shareholders don't have to worry as much about going forward.
Yep. And finally, let's get a look at Chinese automaker BYD releasing preliminary results falling short of analyst estimates. And that's what this looks like. The headline, Julie, we've got some preliminary numbers here. Preliminary 2023 net income between 29 and 31 billion yuan, or about $4 billion. And the street was closer to 31.5 billion, it looks like. So interesting kind of reaction. There was that very good piece that I don't know if you saw in the journal talking about how BYD actually overtook Volkswagen as China's best-selling car brand in 2023. And of course, we know Elon Musk has been talking a lot about kind of the BYDs of the world and China rivals in general.
Yeah, it's also interesting because even though that number came up short of estimates, it's still a 75% gain year over year in sales that the company is projecting. So it's all relative, I guess, versus the whole expectations game. But as we know, there's kind of a pall being cast on electric vehicle demand, particularly in the U.S., but I guess globally there's some questions as well. In addition to that story about BYD overtaking Volkswagen, there was also a story about General Motors and how a lot of the dealers have pushed back against getting only electric, that they say customers want more hybrid vehicles as well. GM is going to
That has been the place to be.
Yeah, it's going to report its earnings tomorrow morning. We're going to talk more about that a little bit later as well.
All right, we move on. It was a record day on Wall Street, kicking off what will be a huge week for the market. Magnificent Seven earnings. The jobs report and tensions in the Middle East all are expected to move markets and influence the Federal Reserve's next rate decision. Also this week on Wednesday, the market is pricing in a pause, with some saying a soft landing may have already been achieved. Our next guest says that line of thinking is too hasty. Let's bring in Victoria Billis-Banry on Capital Management Chief Investment Strategist. Victoria, it's good to see you. Maybe just to start here, we've been talking about different kind of different headline-making events, Victoria, this week. I want to start on earnings, though, and we're waiting for big tech. There, I'm interested, Victoria, so far during this earnings season, interested to get your take. What have you heard, and what do you make so far of what companies have been reporting?
Yes. First off, thanks so much for having me, Josh. In terms of earnings and reportings, I'm very bullish on what we're seeing in terms of the tech companies that are coming out right now. I'm very, particularly, we've been following a lot of the larger sector headlines in terms of technology stocks that are releasing. But I think one of the main focuses that I'd be interested in talking about today is not just how markets are doing overall, but also personally just kind of how we believe that the Fed is going to be impacted by some of the market movements that we're seeing, if at all.
So what do you think? How is, we were talking about this a little bit earlier in the show, Victoria, that our question, and really Josh's question, was sort of, are we going to see Jay Powell come out and try to tamp down some of the equity market enthusiasm when we hear from him this week?
So I think that that's definitely some of the sentiment that we'll be seeing from the Fed and from Jay Powell this week. A lot of market sentiment particularly has been around rate cuts and the necessity for that to kind of tamper down some of the CPI or some of the kind of consumer-based enthusiasm that we're seeing. But I think one of the other key aspects that we need to keep in mind about why exactly I think, for example, rate cuts may not necessarily be in the future of the Fed is that for the most part, based off of the macroeconomic data that we're seeing, things seem to be a little bit under control. Yes, we do have some very high CPI numbers at play, but so long as we continue to see inflation coming under control on top of that full employment, I don't think we're going to necessarily see that rate cuts that investors are really looking forward to.
And Victoria, we're talking earnings, we're talking Fed. I also want to get your take on geopolitical risk. Right now, the market seems to be taking all that very much in stride. I was just wondering, your take on it. Do you think the market's being too complacent about it, Victoria?
I think it's not necessarily a complacency. Good question. I think that a lot of the factors that come into play when we're talking about geopolitical factors, a lot of things that come into play is particularly around I'm seeing war, or if we're looking at, for example, what's happening in the United States with interest rates and things of that nature. What's happening in Israel and what's happening in Ukraine definitely is impactful to a lot of machinery or war-based stocks that we're seeing. So whether that's Raytheon or things of that nature, those are definitely companies that I think are kind of becoming winners when it comes to kind of the geopolitical tensions that we're seeing. And if we're thinking about, for example, more of those financial macroeconomic pressures, I think a strong dollar or a strong U.S. economy is always beneficial to overall markets. And it's clearly starting to reflect a bit in what we're seeing in terms of stock market rallies. But I think that we're in for a shock once the Fed makes their announcement, once the Fed starts to chime in or tamper down some of that later on in the year. And then also, if we're thinking about international markets, what's going on in China right now, particularly with the liquidation with I'm blanking out on the name right now, but basically the largest housing, largest housing manufacturer in the entire country. I think that a lot of that tension has been priced in when it comes to real estate markets, because a lot of their particularly smaller competitors essentially anticipated this, or this has been a rally that's been going on for 2 years, but that can still kind of come back to bite a lot of the real estate market and real estate manufacturing market, not just in China, but also may have a spillover effect here in the US as well.
And Victoria, I know you're also looking at small caps, which is something we've been hearing from a handful of investors as of late. What makes you confident about that group right now? Because they have been sort of volatile and a little bit more volatile than the broader market.
So my overall, I would say, enthusiasm around small cap stocks is that they tend to outperform when markets are kind of coming up from what we would call a downturn or a downswing. Between 2022 and 2023, we were seeing a lot of market tensions related to control of inflation from the Fed. And so we had a lot of growth and like high tech stocks that were, and particularly like the Magnificent Eight that were soaring over the past couple of years and benefiting off of this very high interest rate environment. That is something that particularly does not fare well for small cap stocks or value-based stocks. But now when we start to come back down, or like, again, that growth momentum movement is starting to tamper down a bit more, this is the time when value-based stocks start to really benefit, because again, once we're really starting to kind of like get out of that swing of the bearish market that we were seeing, and now I would say it's more of a bull market with what's happening in the U.S. economy. This is the time when we see small caps, small value kind of fare a lot better versus the traditional growth stocks.
Victoria, it's going to be a big, busy week. Thanks so much for helping us think through it. Appreciate it.
Thanks so much for having me.
Coming up, Boeing set to report earnings this week. Could we see a shakeup at the top for the plane maker? We'll discuss on the other side. The gains accelerating into the close here, and it was a good record day for the Dow and the S&P 500. Jared Blickery here with a look back at today's action. Jared.
That's right, Josh, and throw the Nasdaq 100 in there as well. Not the small caps, but I think investors will take it from the Dow up 0.6% to the Nasdaq Composite up 1.12%. Let's take a look at some of the record closing highs. And I had a lot of alerts today, and they started really firing off at about 340, 345. So it was indeed a race to the finish into the close. And you can see a lot of Mag 7 action here, at least 4 of them. We see Alphabet in there, Meta, NVIDIA, Microsoft, NVIDIA up over 2%. And let's just take a look at the year to date and get that stat for you. We've seen in excess of 20%. There you go, 26% year to date. MasterCard's in there along with Visa. You like pharmaceuticals, Eli Lilly, Merck, Amgen. Well, if you take a look at the software sector, ServiceNow, Caterpillar in terms of the industrials. By the way, XLI industrial large cap space that closed at its first record high since December, late December. So first one of the year there for XLI, the industrial sector. And here's the leaderboard in sectors today. Consumer discretionary, that's XLY, that's number 1, up almost 1.5%, followed by tech, not quite up to 1%. Then communication services, and astute viewers might note that these are the mega cap sectors. So kind of echoes from last year. We've been hearing those are the leaders over the last year. Now, energy did take a little bit of a hit to the downside. Financials also lagging a bit, but for the most part, a very active and engaging day, at least for some of the leaders. Went over the mega caps. Apple, notably, not in the green just yet. In fact, it's been kind of playing with around the unchanged for year to date. And you take a look at that stock, and let's just get a quick look at the year to date. Indeed, coming off the lows there, but taking a little bit of a slide over the last 2 days. Tesla up 4%. That stock in the ringer this year, but it has clawed back a bunch of gains. You can see it's still down about 23%. Today's 4% worth about that much in terms of charts. And let's just look at some of the leaders here. And you can see ARC components. ARC is the number 1 spot there. It's up almost 5%. So disruption playing out well today, followed by IPOs and Bitcoin, cannabis. If you're noticing a theme here, a lot of fringy sectors attracting some money. So maybe the laggards are seeing a little bit of play here. I would know that the Chinese sector, KWEB, down 2.5%. So not gains around the world, but pretty much in the U.S.
Yeah, pretty green there on that screen behind you, Jared. Thank you. Well, one stock that is not green this year is Boeing. The stock, of course, getting clobbered to start the year as the company faces the fallout of a door panel blowing off a jet midair. And the company's gearing up for earnings on Wednesday. But our next guest says the issues at Boeing go back 20 years. For more on the culture and leadership at Boeing, we're bringing in Bill George, former Medtronic CEO and author of True North, Emerging Leader Edition. Good to see you, Bill. So, as you look at this situation at Boeing, you recently wrote about sort of the leaders that led up to Dave Calhoun, the current CEO. Where did the problem start, sort of briefly, if you can sort of summarize, and how does he fix it?
You know, we've had 5 CEOs that have played the short-term game for the last 25 years, starting back with Phil Condit, who instead of gaining share, he bought up McDonnell Douglas, which led him into a lot of trouble. And more importantly, moved the headquarters away from Seattle. And then you had a succession of CEOs. And, you know, if you just look at the stock over the last 5 years, it's down 44%, cost investors about $100 billion. So these CEOs have gotten away from what Boeing's all about. In the last 5 years, they have bought back 121%. They have dividends and stock buybacks, 121% of their earnings. Of course, they've lost money for the last 3 years. So here's a company that's in trouble, but America can't afford to have it be in trouble. This is an American icon that must be restored. And so I think they've got to get back to longer term focus. Now, I've got 5 ideas on how to do that. Number 1, they've got to restore their whole quality system. If I were Dave Calhoun, I would shut down the entire factory for a week and have everyone focus on quality. They've got to change, not just quick fix, oh, let's fix this door plug. No, they got to fix their whole system. Second, they got to redo the whole supply chain to keep farming out things to unreliable suppliers like Spirit Aero. And, you know, they can't even keep the bolts on a plane. And it's ridiculous. Third, they need to design a new single-aisle aircraft. The 737, their workhorse aircraft, it was designed 60 years ago. Can you think how much technology has changed in 60 years? And they don't update. They just keep changing bits and pieces, and they create more problems as they go. And I thought, frankly, if I were they, I would move the headquarters back to Seattle, and Dave Calhoun should move back there himself. And finally, they need to really take a look at their balance sheet. They've bought back so much stock. They have negative shareholders' equity. They've got $54 billion in short and long-term debt, and they're in trouble. And they need to restore the balance sheet to a healthy balance sheet and generate some cash flow, which they haven't done for a long time.
And so, Bill, so you've sort of laid out the strategy here, what you think Dave Calhoun and his team there need to do. Any evidence, Bill, to you that Calhoun and the C-suite at Boeing are going to take on any of these measures you're suggesting?
Not so far. Well, he said he's going to fix quality. But see, they're fixing it a piece at a time. They're not fixing the quality system. But no, he said, he's been in office now, this is his 5th year, and he said, we're not going to have a new aircraft this decade. Well, why not? They had the former head of commercial aviation, Alan Mulally, had a new single-aisle aircraft that they canceled after he left and went to Ford and turned around Ford. They've not gone ahead with that. They need to do that. And that's going to take, 7 or 8 years, but they just need to get with that right now. They're on the verge of losing longtime customers like United Airlines. The United Airlines CEO's in Toulouse this week talking to Airbus about can you get more production out of them. American, Southwest, very loyal. They are all threatening now to say, if you don't get your act together, we're out of here. In fact, one of them said this is a straw that breaks the camel's back. So they've got to restore themselves as America's leading aviation supplier.
Bill, is Dave Calhoun the right guy?
Well, so far, he seemed like he was, but he has not demonstrated it. He is, he's not, he had once ran GE's jet engine business, but he has got to really step up to the long-term issues. He's acting like a short-term CEO, and that's not going to get it. They're not going to cut it. Yes, he's got to do the short-term things, but he's got to have a long-term strategy in place, and he hasn't done that yet. So I'm waiting to see. Will he come forward with that on Wednesday? I'm not optimistic, but that's going to be a key time for him to face down investors. It's not just about door plugs. There's a lot more to it than that.
Yeah, most definitely. Bill, as you mentioned, he is a GE alum. And a number of those other leaders you mentioned were also veterans of GE. Is this yet another sort of hit to GE's one-time reputation as a factory for quality executives?
No doubt. Harry Stonecipher, the former CEO, that got him in a lot of this trouble, came out and publicly said 20 years ago, he said, we're not going to act like an engineering firm anymore. We're going to act like we're going to run this like a business. What an insult to people that have generated tens of billions of dollars in profits. But he said that, and that changed the whole culture to a short-term finance-based culture instead of a quality aviation design culture. And that was the key. And then they passed over Alan Mulally, called him back, Stonecipher back. Mulally should have had the job, frankly. That would have changed everything. So I think Calhoun needs to surround himself with someone, maybe get in a COO if he's gonna, or maybe just be chairman and bring in a CEO who really is a top aviation expert.
And Bill, I'll get you out of here on this. If you're a viewer watching this right now, maybe you have, capital committed to Boeing. How worried do you think you should be, Bill, about Boeing's business and the reputational hit it's taken and potential impact to orders here in the quarters and years ahead?
I think you ought to be very worried. If you'd invested 5 years ago, if you had $1,000 invested in Boeing, it'd be worth, 3 times as much as if you'd put it into the S&P 500. So, I think one should be very concerned about the long-term issues, not just the short-term. See, you can get short-term fixes, but they don't solve fundamental problems of a culture that's moved away from design and quality and safety. And they've got to get back to that. That's number one. And if they don't do that, they aren't going to have a future. America needs them, though. So we can't just sit back and say, oh, well, Boeing's going to go the route of GE. That can't happen. We have to ensure we have a great company in Boeing. And I think that's essential. And so I'm not giving up on them at all. But I do feel like they've got to get back to fundamentals of how you run a business.
Bill George, we always really appreciate your insight here at Yahoo Finance. Thanks so much for joining us.
Thank you for having me. It's great to be back with you.
Take care. Coming up, we've got a vibe check of the economy with author, educator, and creator Kyla Scanlon. That's next. Well, 2023 was the year of the vibe session. Everyday Americans weren't feeling good about the economy, even though the data wasn't necessarily that bad. But that may be changing in the new year. University of Michigan consumer sentiment jumping in January, inflation cooling again. Put simply, the vibes are off to a solid start in 2024. Here to break it all down further is the author, educator, and the one who coined the term vibe session, Kyla Scanlon. Now you're talking about vibe expansion, Kyla. You got another fun word to talk about what's going on. So people are feeling better?
Yeah, I mean, if you can look at the consumer sentiment metrics and see that people definitely are feeling better than they used to, and there's a lot of reasons why that could be happening. A lot of people are pointing to a change in media headlines. Media headlines are becoming more positive. Inflation is going away, so people might be feeling the impact of that. But yeah, people are feeling a lot better, which is quite good for how we think about the economy.
And Kyla, when you look at the data, are all people feeling better, or is it subset of consumers are feeling better?
Yeah, I mean, across the board, the consumer sentiment metrics are pretty strong. You can also look at things like job satisfaction metrics and get an idea of how people are feeling about their jobs. They're feeling pretty good about their jobs as well. Of course, there's pockets of people who are not feeling as good, and that's always something to keep in mind. But across the board, we have seen a pretty strong increase in sentiment from most groups.
So I guess, Kyla, then the question is what that implies about the future path of the economy. If the economy was able to expand last year much better than estimated, even though people weren't feeling great, now that they're feeling better, does that mean the economic growth this year might be better than expected?
Well, if you look at the recent GDP print, a lot of the growth from, how we measured the economy that way was from government spending, from manufacturing spending. And so the question is, can the economy keep on growing if manufacturing spending isn't increasing at the same clip? But if consumers keep on spending money, which they have been doing based on retail sales, we should still see this economic strength continue. So I do think everything is pointing in the right direction, which is good to hear. Yeah.
So if things are moving in a better direction, Kyla, are you surprised President Biden isn't getting more credit for that? And do you expect that to change? Do you think we're going to start seeing his approval ratings move higher here?
I don't know. I think election year is always really tough. I think politics are really tough. You look at the surveys and nobody's super happy about either candidate. And I think that makes it difficult across the board. I do think that there is credit due for Biden and Jerome Powell on how the economy has progressed over the past few years. Like if you had told somebody in early 2023 that the economy would be where it's at currently, I don't think anybody would have believed you. So there's credit due. I'm just, I'm not sure if it'll be delivered to those who deserve it.
And when you're looking at inflation as an input to sentiment here, what are you watching and how important a factor do you think that is?
I mean, inflation is incredibly important. If you ask people their number one economic concern, a lot of times it is, things are very expensive at the grocery store. And so I think inflation and inflation going down is key. However, when we talk about inflation going down, a lot of people think that that means that prices are going to go down, but that's deflation, right? And so inflation is improving. We do see a big recovery. It's getting a lot closer to the Fed's target of 2%. But I do think that, prices are going to remain elevated. They're not going to go back down. And I think that's going to create a level of frustration for people. But there, of course, is going to be happiness that prices are not increasing at the rate that they once were.
And Kyla, I want to get you out of here on this. You say the word of the year is trust, Kyla. I was wondering if you could help kind of walk us through that. What's interesting to me is we do live now in kind of a low trust society, Kyla. Not much trust in government, the economy, media, right? How do you think you improve on that?
Yeah, I mean, I don't know if I can do that concept justice in just a few minutes, but the whole idea is that the language that we use to describe the economy doesn't necessarily reflect the economy itself. Like GDP maybe isn't the best metric to be using, but it's the metric that we use. And so that kind of gets into language not accurately describing the economy, which impacts storytelling and impacts narrative. And then if the stories that we're telling don't necessarily match to people's reality, that leads to an erosion of trust. And we live, as you said, in a very low trust society already. And so I think that building trust back up, however we end up doing that, is going to be extremely important for the economy moving forward.
You're right. I wish we did have more time to talk about that, but we got to go, Kyla, so we'll do it next time. Kyla Scanlon, thanks so much. Appreciate it.
Thank you. Of course.
General Motors among the companies reporting earnings ahead of the open on Tuesday. Here with more on what to expect is Pras Subramanian. The share's up a little bit today, but what are people looking for?
Yeah, you know, GM kind of brought down their forecast for 2023 adjusted EBIT profit because of that strike that affected the first month of production there. So, you know, we saw them come down from 11.7 to 12.7 billion, from 12 to 14 billion. See if they sort of hit that upper or lower bound of that range and see what they say for next year. Let's see what the new target's going to be. You know, speaking of that, you know, the Q4 revenue can be slightly down compared to last year. You know, we had production was not affected so tremendously because they built up a lot of inventory to sort of make up for that. So we'll see what they're going to say about that. EPS around $1.16 a share adjusted, so we'll see if that kind of hits that mark there. One thing that I'm watching though is Cruise. So we had a lot of hiccups there with the Cruise automation, their the AV unit there, had a wholesale clean out of their management, right? New sort of tack there, how they're gonna, what are they aiming for next for their autonomous sort of ambitions? And you know, they revealed a couple days ago a DOJ and SEC investigation into what happened, not just with the actual accident, but also aftermath of it. How did executives ask? So that's kind of a big deal.
And Pras, got to ask you, just back from a trip to Daytona, right? And GM's Cadillac, right, was among the brands racing, right?
Yeah, I mean, so this is the crown jewel of American sports car racing, is the Daytona Rolex 24 endurance race, and basically Porsche and Cadillac, GM's Cadillac, were battling out for 24 hours, and it came down to the last time Porsche sort of just won by a few seconds, actually, after 24 hours. So that's sort of a big deal for them, getting the overall win in that category. It's a big prestigious thing to have. Porsche, this is the second year of a new class of hybrid racing, and Porsche, they had an okay year, but not the best, and this is more along the lines of where they expect to be. And I spoke to their head of motorsport, Thomas Laudenbach, about how important this is for them, not just to win on the track, but also on the road, because a lot of that stuff translates to the road cars.
I would say it was definitely the next step in sports car racing. I mean, maybe as a general comment for us, it's extremely important that what we do at the track, what we do on a circuit here, you know, that it has relevance to what we do with our road cars. And therefore the hybrid step was important. Electrification in itself, you know, take it step by step. And I think it's fair to say we were the ones to commit quite early to the new series. And from what happened after that, I think it gave it a push. I mean, I think it's fair to say that, I mean, we got a huge brand name. It's a well-known name in motorsport, and Porsche entering that series for sure attracted also other brands.
So Thomas is actually an engineer too at heart, and he actually designed one of the hybrid supercars that they did a few years back called the 918 Spider. But also you mentioned brands. You have BMW, Cadillac, as I mentioned, Porsche and Acura in the US, and the sister series, same cars, type of cars in Europe with Ferrari, Toyota, Lamborghini, Stellantis' Peugeot, and also Renault's Alpine brand is all racing, and they all race together at Le Mans in France too, so there's a lot going on there.
I love the background noise that you can hear behind the interview, the of the cars. But Porsche also just rolled out an all-electric new model, right? The Macan?
The Macan EV, yeah.
Macan,
and that's the stuff they're talking about, the battery tech, powertrain tech that will feed into those cars, and they've been doing the Panamera SC hybrid, plug-in hybrid for almost 10 years.
Right.
So they've been doing that for a while now, and it sort of translates from back and forth between race and car to car and race, that sort of thing.
Yeah. Pras gets the best assignments.
Yeah.
That's really how it works. Thank you, Pras. Appreciate it. Coming up, we're going around the horn, checking in on some of today's top trending stories, including the largest cruise ship in the world setting sail. Stay tuned. More Yahoo Finance after this.
Welcome back to Yahoo Finance's group chat. I'm Josh Schaefer here with Alexandra Canal and Pras Subramanian. And today we are kicking things off with shares of Flutter Entertainment, ticker symbol FLUT. The FanDuel Sportsbook parent completing a dual listing today on the New York Stock Exchange. And they're betting that the U.S. market is going to be worth $40 billion in sports gambling, saying that Americans love to bet big, guys. So Flutter, of course, owns several properties, as we're showing, across the world in gambling. But they're the parent company of FanDuel, which is the largest sports book in the U.S. And I talked to Flutter CEO Peter Jackson actually earlier today down at the stock exchange and asked him how he thinks we get to a $40 billion total addressable market by 2030. Here's what he had to say.
We simply looked at the number of states that we anticipate licensing, look at the penetration rates that we expect to get to in comparison with sort of Australia and other markets, and we look at the sort of the average bet size that Americans are doing, and that's where we get to the 40 billion. I suspect it'll turn out to be conservative because everything in America turns out bigger than you expect. So.
Everything in America turns out bigger than you expect.
It's like Texas.
Yeah, right?
For the world.
Right, but for the world. We're like the world version of Texas. But I thought it was interesting. I've talked to Peter several times now, and he points out that quite simply, we do bet more here. We bet more money per bet. And that was one thing that stuck out to me coming from an international perspective as we've sort of watched sports gambling catch on here is people like to put a little bit of money on the table.
Yeah, I mean, I was a little surprised to read about. So you mentioned Texas. It's illegal in Texas.
Yeah,
I know, which is the irony.
I know because I was there.
Were you trying to get your bets in?
Yeah, maybe. But I will say that I note that Flutter is sort of more profitable than DraftKings is, and that DraftKings is the big gorilla in the room, right? And then, but then also the landscape is going to be so competitive with ESPN Bet, right? Fanatics sports are coming online, and even Caesars Sportsbook. So it's a big addressable market, but aren't there a lot of players? I mean, that's a big deal.
One thing we're highlighting here right now on screen, Pras, is how top heavy though currently the market is. You're looking there all the way on the left of your screen is online sportsbook, and you can see FanDuel with 43% of market share, DraftKings with 32% of market share. So you're sort of talking about two behemoths at the top, and then a little bit of everyone else.
Yeah, and I think the explosion of sports betting too is the fact that we're seeing different types of bets, right? Parlay bets. I'm not a hardcore gambler, but I do like a good parlay.
Everyone likes to pick a touchdown score.
The Super Bowl's coming up. Yeah. You know, you can bet on whether or not the national anthem is going to be above or below 2 minutes, what color the Gatorade's going to be. That just invites the casual Betty, I guess you could say. And I feel like that just makes the market a little bigger.
In the sports books, Pras mentioned profitability, and why Flutter thinks that they've made FanDuel so profitable is the parlays. It's when they get you to bet on more than one outcome, the house is winning more often than they do on other bets when you make a parlay. So parlay is betting on someone to throw a touchdown and the team to win, right? Combining those two outcomes. Sportsbooks do really well on that. And I think just generally from talking to people, it seems like that's what's popular right now, right? Everyone wants to tell you about their parlay. Pras wants to tell me about his parlay, and he's got 5 legs in there, and there's all these different outcomes. It's just more popular than, say, I think the Chiefs are going to win the Super Bowl. People want to combine all these bets.
I only go 3 legs, right? 3 is the max.
3-leg parlays.
3 is the max I go.
I thought it was also interesting, Josh. You asked him whether or not the Super Bowl was the top behemoth when we think about the sports betting space, but he actually told you that it's the days where you have more games and more bets on the market that could see more traffic.
Yeah, he said the Super Bowl's still big, but he said a day like yesterday, so we're one day removed from the AFC Championship and the NFC Championship, which was 2 big games. Basically, you get, as I was talking about with the parlays, you get more outcomes for people to bet on, right? Yeah. At some point, you need to be able to, quote unquote, sell more if you're the sports book, and having more outcomes like this is normally advantageous for them. That's why sports books love March Madness. The amount of times you can bet throughout a day, the first Thursday of March Madness when you're watching all those games, it's great for the overall volume in the industry.
Well, with the Chiefs Niners, I'm going to bet on how many times we'll see Taylor Swift on the screen.
Oh, I'm sure it'll be a prop bet.
Travis Kelce.
Really good.
Definitely be a prop bet. But Josh, while you've been looking at what people are betting on, I've been taking a look at what people are watching. And according to a new Nielsen report, it appears like streaming audiences are heading back to the archives as shows like Suits and Grey's Anatomy really start to see a resurgence amid the content licensing boom. And this is pretty staggering. Suits acquiring the most views of all time, even surpassing The Office, almost 60 billion total minutes watched in 2023. That puts it just ahead of the 57.1 billion minutes of viewership that The Office acquired in 2020. And it just shows that you can really have TV series that were on years ago. I mean, Suits debuted in 2011, now getting this new life on platforms like Netflix. And Netflix CEO Ted Sarandos, he had said multiple times that they want to continue licensing from competitors. He splashed cold water on the idea of wanting to license their own original content. We'll see if that changes down the line because you could potentially be leaving a lot of money on the table. And I think that's something that at a certain point, media companies across the board are going to have to weigh. Should we be licensing our content? Should we be keeping it in order to have more engagement? It's going to be a battle.
To me, the biggest takeaway from this is, yes, how do you recreate Suits, but how do you not go fishing in, say, the wrong place for some of these shows too, right? Like, I think Suits has the right characteristics of something that works. It's kind of timeless, it's fun, it's light, it doesn't really... I don't know. It's not a lot of the other shows that people are streaming right now, I think. Like, we stream a lot of good dramas, right? And really intense kind of shows. And Suits, for me, I was one of the people that streamed it on Netflix. And it was, like, just fun. Like, it was just, like, a fun show. And it's like, how do you find shows like that? Like, I know Sex and the City, I think, is coming to Netflix. That might fit that bill, maybe.
I think, we talk about 21 million years of streaming just this year alone, and then the report. Yeah. Netflix has almost all of that, right? For over the last 10 years, they have so much data that they know what shows can really hit from a casual viewer, library content, right? You mentioned Suits. Years ago, it was Friends, right? And then, what's next? And like, what's next? Sex and the City. Maybe that's like what you said, a nice, lighthearted, casual watching, put it on the background. Maybe, if anyone knows what's going to work, I think they know, right?
And they know their subscriber too.
Yeah.
So a key thing is they'll say, oh, you were interested in this series. Yeah. Let me introduce you to another one that you could watch. And in this bingeable environment, I think that's really attractive to users as well.
It will be really attractive to users as well. Anyway, sorry. Let's go to this camera now. 20 decks, 2,000 crew members, 7 pools, 6 water slides, around 10,000 guests. Those are the specs of the world's biggest cruise ship. Icon of the seas, set to sail this weekend. Look, this thing costs $2 billion to make. It looks like a floating hotel. There are some concerns here about the environmental impact of this thing. I mean, it's a lot of energy that it requires to actually motivate itself. It's going to use LNG as a fuel, but then that's cleaner than diesel, but then it's also a lot of methane, et cetera, et cetera. So, a lot of good with this thing, a lot of weird with this thing. I don't know, I'm not a big cruise guy, I don't know what you guys think, but.
So that's kind of my takeaway here. I think it's awesome for people that like cruises, which obviously is who this is aimed for. But as someone that has never really been that into cruises, I think situations like the pandemic have made people wonder if they ever want to go back on cruises and sort of that confined area for a long period of time with the same people and that sort of thing. I don't think this solves that, because it doesn't have that much that's exclusively different than what I would expect the best cruise in the world to have, I guess. I don't know. I didn't see any of those stats and think oh, I finally want to go on a cruise. It just doesn't quite do that for me.
That being said, though, we have seen the cruise line industry really see a resurgence since the pandemic.
Oh, it's doing well. It's just a me problem. I agree.
I was looking at Royal Caribbean stock over the past year, up about 100%. That is pretty substantial, especially given the fact that the pandemic did cause a lot of panic for that industry. You were hearing people trapped on these ships.
Yeah, it's scary.
I hear one of those stories and I'm out.
Yes.
But I'm not actually opposed to all cruises in general.
I
would do a small,
if you have a big group, that could be really fun.
Like an Alaskan cruise and smaller ship, a bit more intimate, more of an adventure, not so much like a floating palace of
So this is too commercialized for you almost because it's so big.
Yeah, it's like,
that makes sense.
I'd rather just have a more of a more confined sort of adventure to a certain place as opposed to we're gonna go to, Cancun and this massive 7,000 person floating arena, and then I'm gonna get sick on it, right? I don't want that, right?
It's just like the travel rebound in general. Planes, trains, the automobiles, cruise ships. I mean, people want to get out there and they want to experience fun things, so why not capitalize on this moment?
And cruising seems like it won't be stopped, right? I mean, it seems like it's not going anywhere.
All right, we got to go check out some of those cruise liners, guys. We're going to find a good one for us. We'll find one that fits all three of us. We'll do the group chat from there. It'll be perfect.
We bet on the ship?
We'll bet on the cruise ship and we'll stream some Netflix. But coming up next, we're going to bring you what to watch tomorrow. We break down the key stories to know to start your Tuesday.
Let's take a look at some of the trending tickers after hours. The companies that reported their earnings after the close of trading. Let's start with Cleveland-Cliffs. The company reported its fourth quarter results. The steel company reporting revenue fairly in line with estimates, losses narrowing compared to the year prior. The company also forecast first quarter adjusted EBITDA meaningfully exceeded that of the fourth quarter. The company says that steel unit cost reductions will be seen of about $30 per net ton. And they said steel unit costs will further decrease in 2024, but the shares are taking a hit. Remember, there was effectively a bidding war for U.S. Steel, one of the four steel majors in the U.S., and Nippon Steel, a Japanese company, ended up winning that, but Cleveland had been trying to acquire it. So imagine there will be some questions about that strategy, M&A, going forward on the call. Same goes for another steel company that reported. That is Nucor. Those shares moving higher by almost 2%. Sales and earnings there beating estimates. $3.16 was what the company reported. $2.88 is what the company is what analysts were expecting, rather. And the company said earnings in the first quarter will be up sequentially. Steel mills in particular will be better in the first quarter because of average selling prices rising. And then let's look at something you make with steel, appliances. Whirlpool numbers out. 2024 outlook disappointing. Wall Street sales and earnings guidance trailing estimates. And the company is expecting now to further reset its cost structure with an additional $300 million to $400 million of a reduction in cost. Basically, people aren't upgrading appliances at the same rate here. Revenue, it says, will be about $16.9 billion this year. Analysts on that basis had been looking for $17.7 billion. We're going to be watching this closely. Whirlpool does tend to be a little bit of a leading indicator in terms of consumers' willingness to spend on big ticket items, obviously closely tied to the housing market as well. And lastly, F5 beating estimates on the top and bottom line for its fiscal first quarter. Second quarter forecast as well, coming in better than analysts had anticipated. Those shares ripping higher by some 7% here. We're going to be talking to the CEO tomorrow, so that'll be a good conversation.
That's right. Francois will be on the show talking about the report. Yeah. Time now for what to watch Tuesday, January 30th. On the earnings front, big day of earnings. Microsoft, Alphabet, Pfizer, Starbucks, and General Motors all reporting tomorrow. Microsoft and Alphabet kicking off a big week for tech earnings in what will be a crucial week for the markets.
Moving over to the job market, the monthly JOLTS report from the Bureau of Labor Statistics for December coming out in the morning. Economists forecast job openings to go down slightly. It will give us more insight on the market ahead of Friday's monthly jobs report.
And taking a look at the economy, new consumer confidence data for January from the Conference Board. It's releasing tomorrow. We're expecting confidence to rise again this month, as did the Michigan Consumer Sentiment Index number last week.
And finally, tune in for another episode of Yahoo Finance's Goodbye or Goodbye. That's tomorrow at 3:30 p.m. Eastern, where we help navigate the best moves for your portfolio.
All right, tomorrow. We got a lot of earnings,
yes,
Julie. It's hard to pick one. Alphabet does really interest me. Remember, the stock returned about 60% in 2023. Team at Jefferies out with a note to their clients this morning saying, listen, their tech's generally pretty good. That's ad budget flush, consumer spend resilient, improving enterprise sentiment. AI, of course, will also be very much in focus.
Yeah, definitely. On that economic data front, I'm going to be zeroing in a little bit more closely on JOLTS, right? The expectation there is for openings of 8.75 million in December, a little bit of a decrease from 8.79 million in November. Obviously, these numbers under a lot of scrutiny because we've seen some strength in the job market. And so we'll be looking for that. We'll be looking at the quits rate as well to see if there's any sign of weakness. David Kelly, JP Morgan Asset Management's chief global strategist, looking at the JOLTS report, he said we could see a further minor decline in job openings, but this would still leave 1 million more vacancies than the pre-pandemic peak, that there is this backlog of job openings. So it's interesting to see that persist.
Economic data, big earnings.
We're going to be busy. Yeah. Yep. All right. That'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.